Hey guys, DD here. Welcome back. Okay, we're in for another video today. And I'm excited about this video because we're going to speak about kind of like the beginning of my Forex trip. In 2015, I purchased this book, Forex Price Action Scalping, by a man named Bob Volman. On the internet that time, there was a lot of talk about him. There were different groups, people trading his method. I ended up joining this guy, Trader Allen, and he was trading his method, and he was getting a lot of pips per month, and he had this website. And it was pretty cool. It's a scalping method, and I thought it'd be a great idea to go through it today, just to give like a understanding about, what it's about, and really just a little bit about scalping in general. So, scalping is something that I think most people, when they join Forex, they get into right away. They everybody just wants to make money, as fast as possible. So, what scalping does is it takes you into the market and you get in and you get out. And people like that because it's money now. What I would say about scalping is that I think it's the most unforgiving method of trading. If you're a beginner, I would not advise scalping because primarily for two reasons. Number one, everything moves really fast because you're trading on a tick chart or a 1 minute chart or a 5 minute chart, and you got to make decisions really fast. So that's number one, a reason that a beginner should stay away. And also, obviously the spread is going to hurt you if you're only going for 1 to 2 to 4 to 10 to 15, maybe probably not even 15. But if you're going for a few pips at a time, and every time the broker is taking 1 to 2 pips on your spread, maybe you have an offshore broker who's giving you a better spread. Nevertheless, you're giving something up probably for that spread, and that just makes it all the more difficult to profit consistently in a method like that. And additionally, the stops got to be really tight. I mean, if you're going for 4 pips, how much are you risking? 2 pips? That's not a lot. That's not that easy, And when you're more of a day trader or even a swing trader and you got these wider stops because you're going for the bigger pips, I think that makes a lot more sense for beginners. So I'm not saying that scalping is not a good method. I actually think that it's a cool method, and I think it definitely works. The point is that you got to be experienced and smart as a trader to scalp. And so why am I teaching it to you guys, this method? So this is another thing. When it comes to learning different methods about Forex, this is what I believe. Let's say you read a book like this, and this book, as I'm going to tell you, is a very specific method. I think that we need to take the information that we get from these books and courses and online videos and everywhere and make something ourselves. They're teaching us general rules, and with those general rules, DD decides that this is how he's going to trade. And he learned a lot from those rules. And you're going to learn a lot from whatever rules that you see and whatever trading strategies you see. But it doesn't mean that you need to go and trade exactly like this. So we could learn this method together, and let's do it right now. And we'll see that we're learning some basic rules. We're learning some things to implement to help us with our trading. It doesn't necessarily mean that we're going to trade exactly like this method. Okay. And I think I want to do another video on this. This will be video number 1. Please like it, subscribe, do all of that jazz. Okay. Hit the notification bell. And we'll get, Bob Volman used to give out these charts to show what he would have done in the market. I'd like to go through that in a video with you too, because it's also a lot of learning. You could see what an experienced scalper, how he really looks at the market. So let's give it a whirl. So here we go. So In the book, there are 7 setups. These are the 7 setups of the range break, the block break, the inside range break, advanced range break, double doji, first break, and second break. Okay, we're going to get through all these. We're going to explain what these are. Let's go first. So the range break is basically, we understand what a range is. It's when, the market is really going sideways, or they call it consolidating, and it starts to make a bunch of highs, a top, and then it goes down and hits a bottom, and then it makes a top again at the same point and a bottom, and it looks like, a big rectangle, as you could see here on the screen. So a range break, and this is really, I think, Bob Volman's genius, and I'm not going to give him all the credit, but what he said in the book is he would wait patiently for the buildup on his breaks. Now, this is a very simple method over here with the range break. You're seeing that the market is hitting that top, and then it's hitting the bottom, then it goes back, hits the top, and it's just ranging as we know through it. He uses a 20 EMA, and he just kind of like waits till it hits the top, and it gets closer and closer, and it's build up, and there seems to be like a pressure. And even you could see over here that the EMA is actually like leading the candles out of the range. So that's the way he did it, and you could see that the buildup is really pushing it out. So that would be called a range break. He didn't go right away when he sees that it's like getting higher. He waits till it actually broke the box, and the 20 EMA is pushing it up, and he would go for like 10 pips at that time. Okay, here's another example, a little bit different. So this one, you see there's quite a lot. There must have been a lot of volume in this market at this time. This is all on EU, right? On the euro dollar. And you see the first top over here and the second top, and then it goes down and hits a bottom. Again, a top. Now over here, this is kind of like a fake out. He didn't go, why? Because there was no buildup over here. There's a huge bullish candle and it broke out. His method and what he teaches is you got to wait for the buildup. You got to wait for the pressure. It could break out without pressure. It happens all the time. But the sustained, breakouts of the range are going to come, and the best highly statistical exits from the range are going to come with the buildup. So he waited after that, bullish candle to go out. It came back in. See, it's going around the EMA again. It went to the top again, came back down, and then you see the pressure, right? And you could even say at this point right here is a good point to like get out. We could talk about that. Then a little bit of a fake out because it just went up. And I'm not saying that, that's the wrong way to go, but like it wasn't really close to the EMA, and then it came back down, and now again the EMA, the moving average, is pushing it out. Give me that little flag and goes out, and you target the 50. Okay, so that's a range break. Then you have something called a block break. Now, a block break is basically a small range break, and if you see Bob's charts, he would trade the block break the most. It's not too often that you have these big ranges, and then in these very sideways markets, some of his more trendy, like going with the trend setups were not as common. So a block break is really just like you see, the market's going up, and then it kind of like makes this top, and like there's again the same pressure going to the top, and the moving average is kind of pushing it out, and then boom, right on the exit with the EMA with all that pressure, and you trade up, and you go for 10 pips or so. Okay, another example. So don't mind this thing on the bottom. This is called an ARB. We'll get to that. Then after this break of this range, this advanced range break, the market kind of went up and hit a top, came back down, and now it's topping. And that's what we like to see for, a block. That's what we call a block when it's topping like that. And, it came back down under the EMA, and the bulls are just keep on pushing, and then it's getting closer and closer. The EMA is getting closer and closer to this top of the block. And right on the exit, as the moving average is pushing it out with the pressure, we go up with a block break. Now, and here's another example. The market was going up, and then it kind of like started to bottom out. So you see it's finding support. So the bulls are in good shape because the bulls were pushing up, and then they couldn't move further, and then it pulled back for a little pullback. And then at this point, again, you see 1, 2, 3, 4, 5, 6, 7, 8, a bunch of different tops over here if you're able to make that little block, and the EMA pushes it out, and you go up. Fine. And then we're not done. Pulls back again, another top, and you see this little flagpole that he made, and then again, the EMA pushing it out, and the bulls will just keep on going higher. So here's, in a span of, this is, 20, 30 minutes, you have 2 block breaks, so you could probably pull 20 pips off that. That's the block break. Okay, then we have the inside range break. Sorry if I'm going too fast for you guys, just want it to be, you could go back, check out the video again, obviously like it, and it helps the channel. Okay, so this is the inside range break. Now, a lot of times, like when the range is just going up and down, it doesn't mean that the only time that you could, trade is to break out from the range on the top or on the bottom. A lot of times, there's going to be a formation or a buildup inside the range itself. So he doesn't paint the top and the bottom of the range over here, but you can see that here is, the top of the range, and kind of here's the bottom of the range. But in the middle of the range, you have like this W bottoming formation. And then look at all that 1, 2, 3, 4, 5, 6, 7, a lot of different candles pushing against this like block in the middle of the range. So again, he's waiting for the pressure, and then he's waiting for the EMA to push it out. Once it does, you're going long. Okay, that's the inside range break. But you see the support over here, and you see that there was kind of like a buildup in the middle of the range. Here's another example of an inside range break, right? You have a nice little range here, and you got to worry about this resistance over here for the bulls, right? There's a lot of consolidation. Then we went lower, and now you see over here that there was a buildup. A lot of people would get stopped out over here. They would go. This wasn't exactly the greatest push out from the moving average and the greatest buildup. So it's going. It's losing a lot of steam over here. The bulls kind of break, but it fails, and then as that happens, there's an inside range break from the top saying, okay, we're trading for this failure. We're assuming that this is not going to work out and the bulls are just going to fail, and that's going to give the bears a lot of momentum. And as they break, with the EMA pushing down against this little block in the range, that's where we're going to go. That's an inside range break. Another case of the same example. You have over here, this resistance that's hurting the bulls' chances. And the bulls weren't able to break out, and there's a lot of pressure over here, and then it just gets lower. You see the lower highs with these little candles, and the pressure pushing it out from the EMA, and you shoot down. So this is what he calls an advanced range break, and basically what that means, it's kind of like a breakout of the range and a retest before you go. Now, in this case, you see that the first time the bulls broke out, it was from the bottom in 3 bullish candles, and they broke out of the range. So that obviously we said is not something that Bob would trade in these range breaks, because he's waiting for that pressure. He's waiting for the moving average to kind of like gently push it out with all the candles. So in that first shot, it wasn't good enough. Now it came back to the EMA and went up again, but still, even though that's kind of a retest, and I understand why you want to get in, maybe you want to put your stop under here, that's fine. And then but it still didn't have that momentum getting it out. But it's kind of like that the range now has a new top. You have 1, 2, and then this third one, and then boom. On that trade, on that candle that goes out, it's a little bit far from the EMA, but it's not too bad. And you definitely see the pressure. It's like pushing against that top, like a kind of a new top, and that's what we would call an advanced range break, which again is like a breakout and a retest, and then kind of like a new range, a new small little block on top of the range. Here's another example of it. Really bullish market going up, 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 higher highs, higher lows. Finally, we reach like a little plateau here, and we're topping. We hit a bottom, which is equal to this support, resistance support, and then it's going up. Here's a little fakie. We didn't really have the buildup, and the EMA was a little bit far out. We're coming out. We're still above the moving average. And now, again, it just jumps up. It's not really with a lot of buildup, because the buildup was going down, and then it just jumped up, and then you have a few candles here, pull back, and now you see that there's kind of like a new high over here, a little bit higher than the range, but you still have that same idea. The EMA starts to push it out. There's a real buildup, and once it goes out of that new high, that's going to be called an advanced range break. Okay, over here you had an IRB, and now the market, starts to go down. This is a range break. He called it tricky, and after it goes back down, after this range break, the bulls try to get up above, but again, look at all this, resistance over here, so that's not going to be easy. So you make that little diagonal line, and it's with the moving average, and you could kind of look at it as like this was the range, and then here's the range break going down. Okay, this one is called a double doji. You guys know what a doji is? A doji is those like tweezer kind of candles where the market opens the price action on the candle, it goes up, and then goes back down, but it ends up exactly where it is. So you have like a wick on both sides. That's called a doji. So when you're in a very trending market, again, this is really kind of just for scalping, but you could use the ideas, for other trading methods as well. When you have a trending market, and over here, like as you see, the market's going up and kind of, has its first real pullback, and then once it hits like a certain support, here was some support, and it pulls back to that support, and it pulls these two dojis, number one, number two. Right after that, you could go long, because it's kind of like the market went up and it pulls back, and now the market's just indecisive. That's what a doji candle means. It means, I don't know, should I go up, should I go down? I can't decide. And it does it twice in a row, and then it breaks the top of that second doji by going up in the continuation of the trend. Go right then, and you could get 10 pips over there. That's called a DD. I'm DD, and that's a DD, and this is a double doji. Actually in his trading, I never saw him really taking those double dojis. He was a much more conservative trader than a lot of the methods that he spoke about. And this is another method that he spoke about, which is really the first break, it's called. And it's basically the first pullback of a trend. Here we broke out of this little block, and then it starts to trend up. It has the first pullback, and once the candle after the pullback, you have a nice, bearish engulfing bullish engulfing candle over here. You go right in. I think that would simply be called an engulfing candle when you see that, but it's specifically with a continuation of the trend. Or you could wait for the second break. Over here, the market's going down and has its first pullback over here, and here's the first one, and you waited until the second one, and then trading down. I like to do this. These are what I call, the M's, or the double tops. Obviously in scalping, it's not a real double top, but on your chart, it looks like a double top, because here's the first one, here's the second pullback, and now when you have the bearish engulfing candle after the second pullback, it's a little bit more confirmation than the first pullback, and I would consider it a little bit more conservative and maybe higher statistics on the edge. Another example, you have the market was totally ranging, and it starts to go down, first pullback, and then you have that bearish candle after the pullback, but that wasn't enough. And you wait for the second pullback, and then shoot it down. Okay, over here too, you had like this little block, and it's kind of, now the market seems to go down. It has a pullback, and it goes a little bit more. And here again, the second one, again with the moving average, he has that little diagonal line. It's the second pullback, again to this resistance line, and then you have the EMA, the pressure, and shoot it down. So guys, to summarize this video, and I want to get into a little bit more details on how he would trade the market. Maybe we'll do it, we'll go back in TradingView and see we'll back test some data and see how he would trade it. But Bob's method was specifically with a 70 tick chart, which means tick charts are when you have the candles are formed by the amount of ticks. So every 70 ticks would create a candle. It's kind of, depends on the volume of the market. It could be anywhere between a minute and a 5-minute chart or a 3-minute chart, depending how much, it goes by the ticks. So that depends on the volume. In a very volatile market, it's kind of like a minute chart or maybe even less. And in the book, he only traded with the euro dollar. But again, you need to think outside the box. You need to understand that this is just a method that he's teaching, but what he's teaching you is about pressure. What he's teaching you is about to be conservative, sometimes to wait to the second break. But he's teaching you that even though you have a range, even though you have a block, sometimes the market decides that's not the top, that's not the bottom. You don't have to get in exactly when the range breaks. Sometimes it creates a little bit of a new high, and then there's more confirmation, to get out. So I think this is awesome method, a great book to really pick up and read. I've read a bunch of trading books. This one is really written for the layman. A lot of them are just really hard to understand for somebody who doesn't know a lot about trading, and they're kind of boring. He kind of entertains you. It's easy to read, and you're really able to pick up a lot of knowledge on basics in the Forex market. So I really recommend it. I've had a few conversations with Bob, over email. He seems like a great guy. Obviously, you never know how well anyone does or not, but the methods seem to work because they seem to make a lot of sense, and you've seen people on the internet trading them. So I hope this video was helpful to you. I do want to do another video on this method, a little bit more in detail. But those are the 7 setups, and there's a lot to learn, and hopefully we could use it for our strategy, and really start to profit on the markets. All right, guys, thanks for the video. DD out.